This is the perfect way to kick off Iconoclast because we have Mr. Iconoclast. I just by title, CEO of Goldman Sachs. It's like you're Mr. Capitalism. Do you ever the weight of that crown? Do you ever feel that?
I feel a lot of weight, a lot of responsibility, but I'm just another guy running a significant financial institution. I'm delighted to be here this morning.
It's true, but it's like
although I can't see anybody. These lights are so bright.
It's better.
Can't see anything.
It's better that way. You know, there's cast of thousands out there. No, I always feel like it's being manager of the New York Yankees, and that no matter how well you do, you got to win championships, or you're on the hot seat. So maybe we'll start a little on the hot seat. You consumer banking, the rollout of that not as successful as you like. It took $3 billion loss so far. The Marcus lending platform. What are the lessons from that foray?
Well, the firm's been around for 154 years, and the firm has built a bunch of super successful franchises. The core business of the firm are investment banking and markets business, what we call global banking and markets, which is over 70% of the firm is a leading franchise, serves our clients incredibly well. We're a proven leader in that for decades and continue to grow that business. We've got a really interesting story that's evolving in asset and wealth management, where we've put a bunch of our asset management businesses that we've built over a long period of time together, and we see a really good growth opportunity to transition that from an on-balance sheet business to a fund-based, much less capital-intensive business. We've got a very, very strong growth story for that, and we're working on it. And then we've had a handful of growth areas over the course of the last 4 years that we've been focused on, one of which is consumer. There's some things that have gone very well in that rollout. The digital deposit platform we've built has made us a very, very significant depository that's been very important for diversifying our funding. But the direct-to-consumer platform was harder than we thought. We've narrowed it. We have 2 partnerships on a credit card platform that we continue to execute on. I don't think we had any belief that they would be profitable in the first 5 years. We're kind of 3.5 to 4 years into that. And so we continue to move forward. I think it's important for a business like Goldman Sachs to always be looking for other avenues to invest in. And when you do that, some things are going to go well, some things aren't. I think what's really important is you look at them always in an analytical way. You make sure that they're serving your clients, your customers really well, and also that they're delivering for shareholders. And if they're not doing it perfectly well, you adjust. And that's what we'll continue to do.
Speaking of adjusting, we're seeing a lot of layoffs across the whole industry. Goldman, you guys laid off, I think, 3,200 people in January. Are there any more coming, or is that it?
I think we made an announcement just a couple of weeks ago that we had, an additional, headcount-focused work that we were doing that was a couple of hundred people. But I do think it's important for people to realize the growth in the headcount, not just of our firm, but of most businesses over the last 5 years has been very, very significant. I do remember just a couple of years ago, we were getting beat up in the press that we didn't have enough people when the world was, really accelerating. And there's no question that as we went into 2022, given how robust markets and capital markets activity, banking activity, markets activity was in 2020 and 21, we probably went a little bit further than we should. I think the other thing that's important to note about our business model is that we've always run our business. It's a professional services business significantly and a people business. We've always looked at performance, and always every year we have approximately 3,000 young people out of school that join the firm, and the only way you can do that and not grow the firm, really, bloat the firm, is that on performance every year you go do a performance review. We stopped that for almost 3 years during the pandemic. Right. That's normally 3 to 7% a year, so it's not surprising that as we reached the end of last year, we did a 6% adjustment. And we'll continue to right-size the firm for the opportunity. Unfortunately, we're in an environment now where the opportunity set for our businesses has contracted, and so we have to make appropriate adjustments, and we're very focused on that.
We have inflation, we have high interest rates, there's pressure on trading, there's pressure on advising. What do you see for the rest of the year, in those areas?
Well, the capital markets activity has been extremely muted. M&A activity has come off. Although I'd say in both those, we're starting to see some green shoots. Confidence plays a big role in those kinds of activities. I'd say generally in our markets businesses, over the last couple of months, clients have been more risk off, a little bit more risk constrained. But one of the things to think about with capital markets businesses is that when you have a big reset, and certainly in 2022 we had a big reset, it takes, 6 quarters or so for people to really come to terms with the fact that this is the new reality.
Right.
We're not going back to the old reality,
Right.
and then the capital markets activity picks up. I certainly don't think that capital raising and IPOs and M&A are going away.
Right.
I just think when you reset valuations and prices, it takes a little bit of time for people to adjust, and therefore, I think we're just at kind of 5 quarters now. I think we're getting there.
So how is that changing how you're advising your clients in terms of raising capital? I mean, companies are staying private longer.
Well, there are separate issues there. I think when you operate a private company and you're operating it successfully, and you have access to capital, and you have the resources you need, the bar for going into the public market should be very high. It's very, very different running a business, a growing business, with the quarter-to-quarter scrutiny of the public markets. And so I do think appropriately, because so much capital is available in the private markets for businesses are staying private longer. And certainly if I was running a private company that was doing well and had access to capital, in an appropriate way, I'd be inclined to keep it private as long as I could. At some point, you reach a size, scale. There are other factors that might change that, but I think that's an important consideration for a lot of private companies. That's different than advice around current valuations, cost of capital, et cetera. I'm a big believer that the reality is the reality, and hope that things are going to be better is not a good strategy. I also think when people take companies public, they often get very wrapped up in what the IPO price is and the IPO valuation is. But generally, if you're taking a company public, the group that owns it owns 100%, and you sell 10, 20% of the company, it really doesn't matter what the price is. What matters is what happens to the other 80 to 90% over the next 5, 10, 15 years. And so, of course, you want to maximize value, but it's much more important if strategically you need to be accessing the capital markets. You accept the cost of capital, do the best you can to access it as tight and as appropriately as possible, as efficiently as possible, but you do what you need to do to make sure you have capital access. Companies generally get into trouble around issues with liquidity, and so it's important that you have your funding and you understand your funding appropriately.
Well, liquidity, it's a good segue. Since the last time we got together at Iconoclast, we kind of had a cardiac arrest in the banking system with FTX, with Credit Suisse, with Silicon Valley Bank, obviously. What are the lessons that you're taking out of this?
Well, the banking system, I actually think the banking system, particularly when you look at the big banks, is in very good shape. And the large banks have really been, through the pandemic and through the last 5 years, a real source of strength. There's no question that we're going through a transition with what I'll call, mid-cap banking, and this, pre what's happened, recently, that's been going on for a long, long time. 25 years ago, there were, I think, 13,000 banks in the United States. Today, there is something slightly more than 4,000, right. But that's been the direction of travel, and there's a reason for that. I do think that, that regional banking and local community banks are important for the ecosystem of capital formation and the small and medium enterprise, economic development system, which creates a lot of jobs that exist in the United States. But at the same point, scale is necessary for efficiency. Right. And when you tighten interest rates by 500 basis points very, very quickly, there are going to be places where things break. And there have been a handful of institutions where the way they were managed, the way they were set up, confidence was broken, and that's always very, very important in financial institutions. Do
you see, obviously, in Credit Suisse, UBS, that wasn't planned, but do you see any more big deals coming like that?
Well, there's debate in Washington around further consolidation in the financial services industry. I actually think there needs to be more consolidation when you look at the mid-size, the regional banks, when you look at the scope of institutions that are, say $50 billion of assets to $1 trillion of assets. When you think about an increased regulatory cost and regulatory burden, when you think about increased technological investment and the cost of that and how that scales, when you think about different liability models in a digital world, I think those things make it harder for a lot of these institutions to earn adequate returns on equity. I think the changes that we're seeing probably can contribute to a 300 to 600 basis point drag on returns for what I'll call the mid-cap banking sector. So, it'd be interesting to see where the regulatory process goes from here. There's talk of more capital in the banking system, and to the degree, that has an impact, that will affect returns. And so that, therefore, should lead to more consolidation. But there are certainly people in the regulatory world and also, in Washington more broadly that do not want to see more consolidation. So that's something we'll have to watch closely.
You guys just made some news where you cut the odds of us going to recession down to 25%. Maybe you want to explain the House view there? That's good news.
Well, the House view is it's an uncertain time, and you can talk to different people in the House, and they'll have different opinions.
I like your House.
Jan Hatzius and his team, our lead economist, who I've got enormous respect for Jan, and I think he's very well followed. He just decreased his team decreased the probability of recession in the U.S. to 25% from 35%. I've said publicly a number of times, I've always been, a little bit more concerned that a recession was a little bit more likely than where he's been. But what I'll say is the economy's been incredibly resilient.
Yep.
The consumer's been much more resilient. And I think it's uncertain, but if you're running a business like ours, I think you have to be prepared for the downside. You have to be prepared for the tail, whether the tail's 25% chance of a recession or the 35% chance for a recession. You have to run more conservatively, because to the degree we do have that environment, you want to be prepared, you want to be nimble, you want to be flexible. I do think that, there's a chance that we muddle through. I think it's very unlikely we have at the moment a very, very hard, recession based on the information that we're seeing. But I do think we could have an environment where you have, 0 to 1% growth and inflation still 3.5 to 4%, and that wouldn't technically be a recession.
It'll feel like a recession.
But that's not going to feel very good if we, if we're grinding through that kind of environment. So, I got a sense that inflation is going to be a little stickier than the current market expectation. We obviously still have very, very robust full employment. It's hard to have a recession with employment rates where they are, and so we're watching the data like everybody else. But I think it's an uncertain time and a time to be a little cautious, because we're having such a dramatic change, in monetary conditions after a very, very, disruptive period between the pandemic, all the fiscal policy, et cetera.
Well, speaking of disruptive, we're in a disruptive political kind of environment. What's the House take on 2024 and the movie signal? Nobody wants to see Biden versus Trump again, but betting person says that's what it's going to be.
We do not have a House view. We're not a political prognosticator, so we do not have a House view.
But in terms of just in general, what's going on in Washington and how that.
Well, I think there's a lot going on in Washington. I'm pleased that we reached a forward path around the debt ceiling. But I do think we have to deal with the fact that we've grown our debt very significantly, and we have headwinds in front of us. We have to deal with the fact that we continue to grow our borrowing just by refinancing treasuries at higher rates now than we've been financing them, for the last decade. And so, we have economic headwinds. I think we're going to be pressured, or at some point the market will pressure us to get our spending more under control. And I think there are policy areas where, we need to continue to make progress. We need to continue to make progress on energy policy, secure energy policy here in the United States that can last across multiple administrations. Immigration policy, we need to keep our borders safe, but we obviously, want to encourage, immigration here appropriately. And, I was down in Washington last week, and I'm hopeful that the dialogue between our administration and our political leadership in China can improve. We're significantly economically entangled with China. We have some significant issues there that we're going to have to work through, and I think there's a lot to do, and so we need our leaders to really focus on these issues and help drive us forward.
Speaking of issues, obviously everybody in any business quarter is talking about AI. What are you guys talking about at Goldman when it comes to AI?
Well, these large language models and the speed with which they're progressing is really fascinating, and it's exciting. There are issues obviously to work through with things like that. An organization like Goldman Sachs has been using artificial intelligence for a long time in lots of different ways. But these large language models, I think, are super interesting, and the pace of change is interesting. We view the changes in the technology, we view it both from a sustainability perspective, it's going to be very important for us when we look at our leading franchises for us to serve our clients as well as we'd like to incorporate some of these technologies to maintain our leadership position in some of our businesses. But also these technologies have an ability to disrupt, certain aspects of our business. So we've got to look at it from both angles. I think the exciting thing that we think about is the ability to apply these large language models against our data set. We obviously have an enormous trove of data that in a variety of different ways, more analog historically, we make available to our clients. And we look at things through the lens of how can we do a better job for our clients? How can we serve their needs more effectively? And I can really see this technology, around our data set accelerating our ability to really, help our clients as they navigate markets, as they try to make decisions.
Tomorrow, Forbes, we're unveiling a new initiative to kind of try to rebrand capitalism. We look at all the surveys and you see people under 30, and even among the college educated, capitalism is becoming increasingly, not a popular word. Goldman Sachs, obviously epitome of capitalism. Forbes, the epitome of capitalism. What's Goldman doing in terms of trying to spread the gospel of capitalism to a new generation in a positive way?
I think I'm an ardent capitalist.
We both are. Well, I think you're preaching to the choir here.
And look, the system's not perfect, but I think it's the best system that there is.
There's no doubt, but we clearly have a messaging issue, don't we?
Well, I don't know that we've got a messaging issue, but I think we all have to continue to work hard to bring people along. We've all got to continue to create transparency. There are a number of things that we do to try to use our resources, people, intellectual capital, and capital to drive economic growth and participation broadly. And I think we all have a responsibility, but markets drive outcomes. Everything's not perfect, but this is a good system, and we need to advocate for the fact that this is something most of the world looks at and strives toward.
That's right. No, I think we have to lean in hard. All right, we have time for one more question. I'm going to ask you a really hard one. You ready?
Sure.
What'd you think of Recession finale?
I'm very embarrassed to say I am about halfway into episode 9. So I have another episode and a half to go. So I've seen some of the news, but I have 1.5 episodes to go. So I can't. Unfortunately, I've been working very, very hard, and I'm behind on my success.
I'm sure the shareholders are happy to hear that. Are you having? Do you enjoy your job? You're having fun. You have a tough job.
I'm a very lucky guy. All these jobs, people run big public companies. They're tough jobs. I'm incredibly lucky. We have incredible business. I have extraordinary people who work for me at Goldman Sachs, and that's one of the things that really motivates me every day. So many smart people that work so hard to serve our clients. I love the opportunity to interact with our clients. That's the part of the job I love. Every day you wake up, a few things go wrong. You deal with them. Yep. You could have 10 other jobs that would be exactly the same.
Well, we appreciate you starting your day with us today and kicking off Iconoclast with us. David Solomon, everybody.
Thank you very much. Thank you.